Good morning, everyone. Good afternoon if you're joining us from Europe. We're hosting another iteration of Value Investors Edge Live, recording at 10 a.m. Eastern Time on June 8th, 2021. Today, we're hosting Star Bulk Carriers, stock symbol SBLK, to talk a little bit about the dry bulk markets and the current environment. Today, we're hosting Hamish Norton, president of Star Bulk, Christo Bergularis and Simo Spiro, the co-CFOs, and Constantinos Simantiras, who is their lead analyst. Welcome, everyone. Thanks for joining the call today.
Thank you for having us, Jay.
Absolutely. The dry bulk market has staged a pretty remarkable turnaround compared to a year ago, especially depths of last year. But there's also been a lot of volatility, especially in the Capesize rates. So let's start off big picture. What's kind of driving the overall strength in dry bulk rates, and how sustainable is this? Is this a short-term phenomenon or rebalancing, or is this a longer-term type picture of the market?
Yeah, Constantinos Simantiras. Yeah, why don't you take that?
Thank you, Hamish.
Yeah.
Well, it has been a very strong start to the year. There's a huge pent-up demand as the world reopens from COVID and vaccination programs are rolled out. There's synchronized stimulus taking place across all major economies, which is inflating import needs. And most importantly, there are huge inefficiencies in trade taking place due to quarantines related to COVID, which creates delays, but also due to political tension, for example, between Australia and China, or China and India, which is creating a redistribution of trade lanes and causes even more inefficiencies. Now, how sustainable this is, we are very optimistic actually, because the supply picture is actually better than ever, both on the short term and medium term. We have an order book, a very low order book of less than 6%, guaranteeing that the next couple of years will see minimal demolitions, minimal deliveries. The capacity of yards is being filled with container vessels and other type of vessels, and at the same time, looking into the medium term, there are environmental regulations that are likely to make the supply picture even better through, slow steaming. There are CO2 taxes being proposed, and so yeah, we are very confident for the next few years.
Certainly a good backdrop, but what are the primary risks, or what are the factors that you're watching as kind of the lead analyst at your company, and as stuff that might be concerning or could be a potential risk factor?
Okay, so well, looking on the supply side, I think that the main risk to monitor is ordering. It's good that we don't see any ordering right now, but a strong increase in ordering would definitely be a warning sign. A potential sharp correction of oil prices, which again, I currently do not see it. We are still at very early stages of the world reopening. Then on the demand side, we could see, I would say a potential escalation of political tensions that would cause a prolonged correction of Chinese imports. Again, it's very difficult to say if this is possible in terms of supply and demand. And maybe later in the year we might see the Chinese growth slowing down as they try to control commodity prices. But this is one of the few years where we have the rest of the world growing at really high growth rates, and we believe that this will mitigate any short-term, slowdown from China.
So it sounds to me like on a global macro sense, you're obviously paying attention to China and China's growth, and also global GDP growth, and then on a more micro sense, you're watching that order book, making sure that stays small.
Exactly, spot on. And we need to highlight that right now we even have developed economies that are growing at a really high pace due to the the pent-up demand and restocking that is needed. And this is something we haven't experienced for almost a decade.
Certainly, I think the infrastructure is also a point of investment. I know the United States is pursuing a major bill. It's going to take a while to pass, through the political system, but there just hasn't been a lot of infrastructure investment since the global financial crisis, right? Since 2009, 2010. There's really been a decade of underinvestment in infrastructure across the United States and Europe and many other countries. So hopefully we'll see a swing back there.
Yeah, exactly.
Yeah.
So, on a related note, because you mentioned China, and one of the topics we've kind of followed closely is the China-Australia tensions around the coal import ban. How much of an impact is this having on dry bulk? To me, it seems like it's definitely helping the mid-sized market, but is that a major factor, and how much should we be watching that particular part of the market?
Well, you correctly said that it has had a positive effect on the mid-sized vessels, but generally this is positive. This is medium to long-term positive, because in the short term it creates inefficiencies in trade, the redistribution of trade lanes. It's positive for ton miles, as we are seeing that China is importing from longer distances, like South Africa, like the United States, Canada, Colombia. We believe that even if the tension is between China and Australia, China will try to diversify their import needs away from Australia, and this will be a medium-term positive. And it's not only coal; it's actually iron ore as well. I mean, we should see more, iron ore coming from the Atlantic, from Brazil, as more volumes come during the next 2 years.
Yeah, it's certainly very interesting to follow from a geopolitical sense, right? China has this massive dependence on Australia for their iron ore, right? They've been investing in Brazil for the last decade. They're investing more and more into Africa. There was a leaked document that came out. It was in the Australian press a couple of weeks ago, talking about China's, I think it was 5-year plan to kind of diversify away from Australia. And of course that is very bullish for dry bulk, because the ton miles are far longer to go to Africa or go to Brazil. So very interesting to follow that. Pivoting a little bit here, I mentioned it in the intro, but these Capesize rates, and I know they're always volatile, but the Capesize rates have been remarkably volatile over the last month or two, whereas the mid-size rates are flat. I mean, they're so strong and so steady and just very strong. So what's the disconnect between those two markets?
Well, and I'll let Konstantinos amplify on this answer, but I mean, I have to say the Capesize rates have been quite volatile compared to Supramax and Panamax rates, but the Capesize rates, I wouldn't say they've been unusually volatile in a percentage way. In a dollars per day rate way, they may be very unusually volatile, based on recent history, but their percentage volatility is not unusual. What's unusual is how steady the the Panamax and Supramax rates have been. And Constantine, why don't you?
Well, let's talk about the disconnect. I mean, on the smaller sizes, the smaller sizes enjoy a broader, spectrum of cargoes. They have been enjoying a really a record high exports of grains. There is a cascade on coal trades, as we mentioned before, and then there's a cascade even from containers due to the boom we're seeing in container rates. That we see cargoes being redirected into dry bulk, actually, and more importantly, on the smaller size, there has been a huge boost from steel exports due to widening arbitrage between the West and the Pacific. I mean, if you look at steel prices in the US, in the EU, we are at $1,300, $1,500 per ton. And in the Pacific, the steel prices are around $800, $900 a ton. There's a huge arbitrage, which has pushed backhaul cargoes and backhaul rates significantly higher, is supporting the smaller sizes. Now on Capes, you are right that they've been more volatile, but this is traditional seasonality for Capes. I mean, during the first few months of every year, we have significantly less iron ore exports taking place, especially from Brazil, which is a really important ton mile contributor. And at the same time, there has been major issues on some Brazil terminals in Ponta de Madeira specifically, which caused a strong increase of VLOC congestion. And this actually created some oversupply in the Atlantic. And at the same time, we had strikes in Colombian coal affecting coal exports, strikes in Canada Canada, affecting iron ore exports. So there were limited alternatives for the larger vessels. The good thing, though, is that during the last month, we've seen all the negative factors slowly reversing, and we expect that gradually over the next 1-2 months, you will see a tighter Capesize market and more normal spreads between the larger vessels and the smaller sizes. I mean, with Panamaxes at high 20s and 30,000s, I mean, the upside potential for Cape is really, really high. So let's see how this will play out during the next quarters.
Yeah, it'll be exciting to see that, and the FFA market, forward freight agreement market, certainly agrees. I mean, the July numbers and the Q3 numbers are much higher. I think they're in the mid 30s now. However, this brings up another point, a question I wanted to ask. We look at the FFA market, and I realize it's not super liquid, but we look at that and we see a very weak calendar 22 FFA market and a non-existent really calendar 23 FFA market, even though you and I know, and we just talked about, the order book is non-existent. The global demand is obviously growing. So what's going on with this FFA market? Why are the 22 levels so low?
Well, Jay, I think we should not be using FFA as a market signal because the forward curve, the forward contract, as you correctly said, of 2022 and 2023 are relatively liquid. But if we need to say something about that, it's the steep backwardation usually can be viewed as a sign of a bull market signal, but we definitely cannot use it as a forecast. And perhaps we will talk perhaps for our chartering strategy later on. But yeah, I wouldn't focus too much on the forward contracts, and I would focus more on the fundamentals, as you correctly said.
Yeah, so it certainly makes sense. I mean, we just don't have the liquidity, right, and participation in those FFAs. I know the front month, right, July, and the front quarter, Q3. There's a lot of speculators in there. There's a lot of companies and such in there, but there's not a lot of volume in 22. This is kind of an oddball question, but is it possible to add like a synthetic operating leverage to your company by buying a bunch of those 22 FFAs on the long side? Is that possible?
I mean, one could, in principle, buy FFAs and add operating leverage. It is a relatively risky thing to do because, for example, if the trade goes against you, you have to put up cash collateral well in advance of the actual cash flows from the FFAs maturing. Frankly, we've got more than enough operating leverage, we think, as is. Every $1,000 a day is about $46 million annually to our bottom line.
I would add here, though, that we've been discussing that with our chartering department, and there sometimes there are arbitrage to be taken off. I mean, you might go out and charter a vessel for a year or 2 years going into 2022, and then you might go out and buy back the 2022 calendar and lock an arbitrage between the two. That would be a safer choice, and without taking the risks that Hamish mentioned.
Yeah, that certainly makes sense. I'm just throwing out wild ideas, because I see the calendar 22 FFAs, and they just do not make sense to me whatsoever.
We are definitely thinking of these things, but yeah, there are risks involved, as Hamish correctly said.
So you mentioned that the big risk on the supply side, and this is something we watch very closely as well, are potential new builds. So if a company wanted to go out there today and buy new ships, hopefully they won't, but let's say they went out there next week and ordered new vessels, how long is that going to take until they deliver? What kind of time frame would that be?
Well, if you order a new building today, let's say it's about 2 years to get delivered. But the new building you order today, first of all, is going to cost you a lot more money because steel prices have just about doubled. And on a Capesize dry bulk carrier, that is something like $14 million of extra cost because of steel. And then, are you going to order a ship with a fuel oil only engine? Given the carbon and the carbon emissions regulations that the IMO is going to be enforcing from 2023 onwards, you know, you might look pretty stupid ordering a fuel oil only ship today. But of course, the alternatives have problems as well. You know, you could order a dual fuel LNG and fuel oil ship. LNG doesn't necessarily solve the political problems around greenhouse gas emissions, but you know, it will cost you, you know, another $5 to $10 million.
And just
to
to add
the LNG, yeah.
Just to add, this is Christos, to what Hamish has just said about the lack of options for sort of zero carbon emission engines. Slots are taken by other segments that need higher value vessels from shipyards, for example, containers. So given that shipyards have filled their imminent slots, in Japan, for example, we do not see available slots until well into 2024. In China, we may find some slots in 2023 in second and third tier yards. However, in good shipyards, taking delivery of a new vessel, you're really talking about 2024 with all the hesitation in ordering a new vessel, given what Hamish has just said about the dual fuel LNG engine.
Yeah, I think that's a really important color because you mentioned the rising price of steel and the uncertainty in propulsion, and you add those two together, and you're talking about a $20 million increased price tag, and you're talking about 2024 delivery. So it just seems like a beautiful setup on the supply side. We just really hope that you know the other dry bulk companies don't screw it up and overorder.
Jay, you can also add the FFA of 2024 being extremely discounted, so it doesn't offer any support there as well.
Yeah, definitely interesting. We just hope it'll continue. And I've been very, very happy the last year to just see like almost zero dry bulk orders, and hopefully it remains the same. So let's pivot a little bit. I think Hamish already kind of started to a little bit. Let's talk about the upcoming environmental regulations. And there's also a proposal out there for some sort of carbon tax. So how would these proposals impact Star Bulk, and what is Star Bulk doing to position themselves?
Okay, so look, just big picture. The more regulations and the more intrusive the regulations, the better Star Bulk does relative to its peers, because Star Bulk is one of the very largest companies in the dry bulk business, and we can afford to pay for the cost of regulatory compliance in a way that some of our peers might have more trouble. The regulations coming up start with something called EEXI, where basically ships will have at one time in 2023 to meet a fuel efficiency requirement, which will be largely solved through something called engine power limitation, which is really just what it sounds like, limiting the power that our engines will be able to produce below the power that they were designed to produce. And this engine power limitation will be able to be overridden by the captain in a safety emergency, but otherwise, it will require the engine to burn less fuel, and for the ship, therefore, to have a lower top speed. Other things that can be done are adding other fuel-saving modifications, such as ducts just before the propeller that make the propeller more efficient, better bottom paint, more frequent hull cleaning, or basically hull cleaning robots, or wind-assisted ship propulsion. But primarily it will be engine power limitation. Then from 2023 on to 2030, there will be something called the Carbon Intensity Index, which is probably more important, which will require ships to basically produce less and less CO2 per unit of transportation work. And, you know, that will require not just engine power limitation, but, you know, probably weather routing and speed optimization. Again, probably more expensive bottom paints, probably more frequent hull cleanings, wind-assisted ship propulsion can be a factor, and you know, other fuel-saving technologies such as that. And we are looking at all of that. You know, our fleet is relatively more fuel efficient than the average. So, you know, we will have less trouble with that than some.
Yeah, it's certainly interesting, and when I hear engine power limitation, I can't
It's
imagine.
great. It's great
I
because
can't imagine anything more bullish.
right, because basically
Yeah.
what happens is if you have a strong market today, the fleet will speed up. Whereas if you have a strong market in 2024, 2025, there will be a real ceiling on how much the fleet can speed up.
Yeah, it's pretty remarkable, you know, and the more
Yeah.
I hear about these regulations, the more bullish I get on our particular companies, right, and particular tonnage. But a lot of times, you know, from investors, I hear, you know, folks are afraid to invest in shipping companies because of, you know, their fear of regulation. So it seems like there's a disconnect out there in the messaging. You know, what sort of things do you think companies could do to get over that messaging? Is there some sort of better way to frame that or communicate that stuff?
Well, they should be talking to you.
We'll see. We'll have to see. But no, it's very interesting,
Uh,
and engine power limitation is such a phenomenally bullish thing, and it just doesn't seem to be getting the headlines it deserves.
You also mentioned the potential carbon tax, where the effect would be similar. I mean, it would
Yeah.
actually create even further slow steaming pressures, and it will be a market-based tool to decrease speed and push freight rates higher. Actually.
Yeah, no, a carbon tax is the same thing as high oil prices, and you know, high fuel prices are good for dry bulk. They're not good for the container business necessarily. They're not necessarily good for the tanker business because tankers carry fuel, but dry bulk ships, you know, do not carry fuel oil. They burn fuel oil, and the more expensive the fuel oil gets, the slower the fleet will tend to go, and therefore, in effect, the carrying capacity of the fleet is reduced, which drives charter rates up. So the carbon tax is great for us.
Yeah, I mean, there's a phenomenal chart that was just posted on Twitter a couple days ago that shows even the last year, just over the last year, there's been obvious changes in the global fleet speeds based on the rates. It
Yeah.
responds almost immediately to both the bunker fuel rates as an input and also the time charter and spot rates as inputs.
Yes. Yes.
Correct.
So we love to see it. I like to hear about this stuff. I don't, you know, necessarily want to take a political stance one way or the other, but as an investor, you know, I see these things in a bullish light. So let's pivot a little bit and talk about the company overall capital allocation priorities and target leverage. Right. So Starbulk, you built up a lot of leverage over the last couple of years as the markets were tougher, and you did a huge scrubber program. Now you're delevering and you have a clear dividend program. What should we think of the allocation priorities going forward?
Well, okay. So, you know, for the near term, we will be focused on the dividend and deleveraging. And, you know, we're certainly not ordering new buildings at the moment. You know, we certainly don't rule out acquisitions, but, you know, any acquisitions we make, we'd like to use our equity. You know, we don't want to interfere with the dividend and the deleveraging. And, you know, we may be able to use our equity in very accretive ways if we're trading, you know, at a significant premium valuation.
Yeah, let's hope you have the opportunity to do that, right?
Yeah.
That'll mean your stock goes
Yeah.
up a lot. So
Yes.
let's hope that's a possibility. I mean, you had a moment, you had a window a few weeks ago where you were trading at a bit of a premium, and then it quickly came back down now. So hopefully we'll get back up there.
Yeah, I mean, you know, look, the FFA market and the spot market were quite a bit higher, you know, I think that we believe will return, you know, we're pretty optimistic.
So I mean, considering, you know, your optimism and considering the facts that we know about 2022 on the supply side and the hopes we have for the demand side, what's your time charter strategy at this point? Is it mostly spot? Are you taking any sort of time charters?
Well,
Okay.
we are chartering out well, why don't, yeah, Constantine,
Yeah.
why don't you address that?
We are currently focusing on the spot market and opportunistically doing some short periods. When I say short periods, we're talking about 3 to 5 months, 4 to 6 months. Main reason is that we have a very positive market outlook, and the forward curve, as you said, it does not justify taking longer coverage because we would have to accept really big discounts on on the prompt months. But you know, as the year progresses, and you know, as we go into Q3 and Q4, perhaps this will change.
And it's
So
the
that's
smaller
mainly
ships. It's the smaller ships that we're chartering out, right?
correct. Yeah, you're right, Hamish.
Yeah, that certainly makes sense. We just got done talking about the calendar 22 FFAs being way too low. So I was hoping you weren't fixing out your entire fleet for 2022 at these rates.
Yeah.
Excellent. Let's talk about scrubber. So huge scrubber program, big investment in 2019 into 2020, and you know, COVID kind of derailed that a little bit in terms of the fuel spreads. But now the fuel spreads are back. So what are you doing now? Are you hedging any of that, or is it all just excess cash flow?
We're not hedging yet in any significant way. You know, we might hedge at higher spreads between low sulfur and high sulfur fuel. The spreads in the spot market right now are order of $120 a ton. And in the forward market, they're somewhat higher, but you know, they're not quite where we would want to hedge significant amounts.
But I think, Hamish, that we would also like to see the reopening of world economies. We're at the early stages, especially in terms of oil consumption and jet fuel. And you know, with the signals we've taken from other commodities, they've really surprised us to the upside. So for now, I think there's no need to hedge.
Right, but just to you know, get a sense for the impact, even at $120 a ton spread, you know, we burn, you know, somewhere between 800,000 and 1 million tons of fuel oil per year, you know, depending on the strength of the market and the speed of our fleet. And you know, at $120 a ton, that's more than $100 million to our bottom line as a result of the scrubbers that cost us on the order of $230 million.
Yeah, significant. I mean, and that was even with, I would say, a disappointment last year, right? So, and even then, it's 2-year payback.
Yeah. I mean, at $120 a ton, it's on the order of it's a little over a 2-year payback, but not much. And you know, in January of 2020, the spread was $350 a ton, and you know, I'm not sure I'm expecting that to come back in the same way, but we're expecting it to be more than $120 a ton.
Yeah, it's remarkable to see that, and you mentioned, yeah, it's 120 right now, and it sounds like if we got higher levels, which maybe you are hoping for, you know, 140, 150, then you would start to do more of a hedging strategy. Is that fair?
Yeah, at higher levels, we would be more inclined to hedge.
Yeah, certainly, certainly makes sense. You'd hope so. All right, fantastic. I know the scrubbers were, I mean, it was controversial, right? In 2019, it was a controversial investment. In 2020, it was kind of uncertain, and now we're reaping the rewards from that investment. At least it looks like that.
Yes.
So what? I guess what else? The question that a lot of investors ask, and you know, what risk factors? I know we covered this at the start, but I think it's worth circling back. We mentioned the order book. What other sort of risk factors are we looking at? Is it just all global macro stuff, or are there other sort of niche areas?
It's basically global macro risk factors. You know, or you know, sort of crazy black swans. You know, like a global pandemic was obviously bad. You know, and you could imagine, you know, other things, you know, could be bad. You know, horrible earthquakes, tsunamis, you know, affecting specific ports could be, you know, bad things. But how can you predict things like that? You know, the world looks like it's set up to be very good for dry bulk for the next few years. But you know,
there's
crazy
some political
things,
risk.
Yeah.
But yeah, how can you predict that?
Yeah, and I think that's true for, I mean, any stock on the stock market, any company is going to face those same sort of political and regulatory risk and that sort of things. But
well,
you know,
the regulatory risks seem to be all good.
Which is, you can't say that for too many businesses, can you?
Yes.
So certainly very interesting time. We'll keep our fingers crossed, of course. I mean, we've been, the last couple of years have been both humbling and rewarding, right? In different phases for shipping investors.
Yes.
So we'll keep our eyes on the horizon. So thanks again, Hamish and the team, Christos, Simos, and Konstantinos for joining us today. Closing remarks from Hamish and CFOs, if you'd like. What differentiates Starbulk? Why pick your stock over, you know, all the peers that are out there? There's way too many dry bulk stocks out there. So why pick Starbulk?
So Starbulk, I mean, we have a fleet that is broadly spread over the range between Supramaxes and the largest Capesizes. So we give people exposure to all the sizes. You know, we have a strong balance sheet, and you know, we have the kind of corporate governance that you would expect of a U.S. listed public company, which is, you know, not universally the case in this industry. You know, we have real institutional investors on our board. We have a compensation committee that is serious about paying management when the shareholders make money. Management are all employees of the company. Everybody who works on managing our ships is an employee of the company. And, you know, because we're incentivized to think and act like shareholders, and in fact, we are shareholders, we focused on getting the lowest operating cost in the industry. We have the lowest overhead in the industry, and we have excellent chartering results. So, you know, that's really what differentiates us.
Although Hamish has covered a broad range of attributes for Starbulk, just to add that we are the largest US listed dry bulk company, and hence we also have the highest liquidity. And as we have discussed during this call, we have a dividend policy that basically returns all free cash flow generated above a certain threshold to our shareholders.
And scrubbers, I would say. It's also important that we have almost 120 vessels fitted with scrubbers, and you know, as the economy rebounds from COVID, it's going to be really energy intensive, and in an increasing oil price environment, we will be earning some additional earnings from those.
As well as, you know, a very competitive platform. I would say the most competitive in terms of you know, cost break even among any of the other public peers.
Yeah, I think you made the case very well. Centered around the largest, most efficient fleet and strong corporate governance, and that
Correct.
corporate governance is particularly very welcome in the shipping space, and I'm very happy with how Starbulk's been managed. So thanks again, gentlemen, for joining us this morning.
Thank you.
Thank you, Jay.
Have a good day.
Thank you.
This includes another iteration of Value Investors Edge Live. We just hosted Star Bulk Carriers, stock symbol SBLK, to discuss the dry bulk markets. This is recorded on 8 June 2021 at about 10 o'clock Eastern Time. Nothing on this call constitutes official company guidance or investment recommendations in any form.